Students, welcome to my live teaching learning session of BECE 144 Financial Economics. Today we will discuss about Unit 8 Risk and Uncertainty and Valuation of Bond Yield. Risk and Uncertainty. You know that future is uncertain and risk involved in bearing. If we want to bear risk, then we will earn more profit. There is a trade-off between risk and return. If there is a low risk, then return will be low. And if there is a higher risk involved in financial market, then high potential return will also include it. So there is a inverse relationship between risk averter and risk lover person, but risk and uncertainty, risk and return both have positive relationship. More risk, more return, less risk, less return. In financial market, there is a lot of risk involved. If people are risk averter, then they will invest their money and they will save their money in banks and they will get fixed rate of interest. But if you invest your money in share market or in financial assets like in paper title documents or in securities like shares, bonds, debentures, then there is a huge risk involved in these financial assets. But you know that profit is risk bearing award. This line was said by Professor Holly. According to him, if we bear more risk, then profit will be higher. And if we bear less risk, then profit will be lower. So profit is risk bearing award. Same as if we take more risk, then return potential will be higher. And if we bear less risk, then return potential will be lower. So this is the relationship between risk and return. But before starting this risk and uncertainty, first of all, we will discuss about bond yield. Because in last session, we have discussed fixed income securities. And fixed income securities are those securities on which investor get a fixed amount after maturity of these securities. So what is the meaning of bond yield and how bond yield can be estimated or calculated? So what is bond yield? Bond yield is the amount of return an investor realize on a bond. What is bond? Bond is a paper title document. It's a security in which investor can invest his money. And yield is the expected return. So bond yield is the amount of return an investor realizes on a bond. Several types of bond yield exist, including nominal yield, which is the interest paid divided by the face value of the bond. If the face value of the bond is 100 rupee and interest paid is 10%, then we can estimate nominal yield by dividing interest paid by the face value of the bond. And current yield, which equals annual earnings of the bond divided by its current market price. Additionally, required yield refers to the amount of yield a bond issuer must offer to attract investors. So, here, three types of bond yield we can explain, like nominal yield, next is current yield, and next is required yield. Nominal means which is affected by inflation rate. So nominal yield is the calculation of yield when interest paid divided by the face value of the bond. And current yield we can estimate, which is equals to annual earning of the bond yield divided by its current market value. And required yield refers to the amount of yield a bond issuer must offer to attract investors. So these are the different types of bond yield and the definition of bond yield. Next is, here is a inverse relationship between the market value of the or market price of the bond. Bond interest payments are preset. So the less you pay for the bond, the higher percentage income those payment will represent. So reverse is always true. It means if bond price is less, then you can earn more yield, more income, and if bond price is higher, then yield will be lower. So there is an inverse relationship between bond price and bond yield. If you buy bond at higher price, then how you can earn maximum profit? It's not possible. But if bond price is less, then you buy, and when bond price is higher, then you sell, then you can earn maximum profit. So investor always buy these securities like shares, bonds when their price is lower. And when price will become higher, they will sell it. And they will get huge return or maximum profit. That's why investor invest their money in these securities to earn maximum profit. So this inverse relationship is shown by this diagram, like yield is up and price is less. If price will be higher, then yield will be lower. Next is, if interest rate rises or if interest rate fall, then what will happen? If price falls, yield rise. If price rise, yield fall. Same as if interest rate rise, if bank will pay you more rate of interest, then you will not invest your money in bonds. You will invest your money in banks. If bank will provide you higher rate of interest. And if bank will not give you high rate of interest, then people will invest their money in bonds or securities to get higher return. So if interest rate rises and if market price fall of the bond, then bond yield will be rise. And if interest rate falls, if bank will not pay you high rate of interest, then there is no opportunity to gain maximum profit by investing your money in banks. Then you can buy bonds at lower price and you can sell it at higher price. Then you can earn maximum profit. So this is the relationship between yield and price, and interest rate and investment in bonds. Investment in bonds and rate of interest have always inverse relationship. If interest rate higher, then people will invest less in bonds and save their money in banks. And if interest rate is lower, then people will buy more bonds and less invest in banks. Next is bond yield. Now, bond yield, maybe it is yield to maturity. We need a measure of return which takes account of both. It means current yield and changes in the bond's value over its lifetime period. So, current yield, which can be estimated by interest income and changes in the bond's value over its life, it means capital gains and capital losses. Either you can earn capital gains or you may bear losses. That will be called capital losses. This measure is called yield to maturity. Yield to maturity is defined as the discount rate which makes the present value of the bond's cash flow equals to its price. So, bond yield means the return from investing money in bonds. Yields may be higher, yields may be lower. Depends upon price of the bond. If price of the bond is higher, then yield will be lower. And if price rate falls, then bond yield will be higher. And yield you can earn after maturity of the time period. Next is bond valuation. There are different terms which we can use in fixed income securities or in calculation of bond yield. First is coupon payment. The coupon payment is the interest paid annually or semi-annually. Typically, these payments are fixed so that the interest paid each year is the same. When the interest payment is fixed, that is why it is called fixed income securities. And principal is the amount borrowed and repaid at maturity. Coupon rate is that rate or it's the annual interest payment divided by the principal. If the annual interest payment is divided by the amount principal which we have borrowed, then we can estimate coupon rate. And current yield is the annual interest payment divided by the price or present value of the bond. Capital gains yield is the change in price over 1 year divided by the price in the beginning of the year. So we can calculate by using this formula PV1. It means present value of current year minus present value of base year divided by present value at the beginning of the year. Then we can estimate capital gains yield. And yield to maturity is the return investors expect if they buy the bond and hold it until it matures. If the market is in equilibrium, the yield to maturity is also the return investors require given the bond's risk. It means if market is in equilibrium position, then the yield to maturity is also the return, the maximum amount which investor always require to bear the risk by taking the bonds. So yield to maturity is the return which investor always expect, what amount he will get after buying the or after investing the money in paper title documents or in securities like bonds. So these are the different terms which we can use in valuation of bond, like coupon payment, principal amount, coupon rate, current yield, capital gains yield, and yield to maturity. Next is how to calculate yield to maturity. Yield to maturity is written by this short form YTM. This Y is yield, T is time or to yield to, M is maturity. Yield to maturity is equals to C plus FV minus PV divided by T, then again whole this value divided by future value or face value plus present value or price of the security divided by 2. What is C here? C represent coupon payment. FV is face value of the bond or face value of the security. PV is the present value of the security. And T is the time period. How many years it takes the security to reach maturity, that is called T. It's a very simple formula. YTM, yield to maturity, can be estimated by using this formula. C is the coupon payment or interest amount plus face value minus present value divided by time period. Whole this value is again divided by face value plus present value divided by 2. So this is the formula of yield to maturity. In this here the example of estimation of yield to maturity, how we can estimate it. If we have given bond period is 5 years, interest coupon rate is 9%, issue price of bond is 90, redemption value is 105, income tax is 30%, capital gains are taxed 10% by the rate of this, and prorated discount is 13.50, and coupon rate or coupon payment is 6.30, post tax redemption price is 104, then yield to maturity is calculated using the formula given below. YTM is equals to coupon. Coupon value is 6.30, which is in this Excel sheet column B, and serial number is 16. So B16 is written here. It means in column B and the row is 16, value is 6.30 plus B12. B12 means prorated discount. If we add coupon plus prorated discount divided by redemption price is B20, which is post tax redemption price 104, plus purchase price is here B8, that is the issue keep the bond as it is valuated. Next is if YTM is less than YTM star, then decision to sell the bond as it is overvaluated. There are two types of values. One is potential and next is actual. Potential is denoted by star and actual is denoted by simple YTM. So if YTM is less than YTM star, then decision to sell the bond as it is overvaluated, and if both are equal, then bond is valuated at the same range in the market and is the current market price shows the intrinsic value. Intrinsic value is the materialistic value of that thing. So these are the three approaches through which we can estimate, we can take decision while investing our money in bonds. These three approaches we have to remember in our mind if we are taking decision investing in money in bonds. Next is certainty, uncertainty, and risk. Now, this is the part of Unit 8, Risk and Uncertainty. Before understanding this topic, risk and uncertainty, you must have to know about what is the meaning of certainty, uncertainty, and risk. Here, certainty means if we are certain about future that this thing will happen in future, we are sure and definitely we can say that it means that thing is certain or predetermined. So certainty models constructed under assumed certainty, for example, many financial models are based on particular expected return that is called certainty, which can be easily to develop and solve. But in case of uncertainty, as we know that future is uncertain, anything can be happened in future. We can't predict regarding government policies and monetary policy and other policies which is made by the government. We can't determine it and we can't take any type of insurance against the losses of government policies which can be occur in future. So these uncertainty may be insurable or uncertainty may be uninsurable. Some uncertainty like famines, flood, earthquake, these natural calamities, anytime they can occur. So we can take insurance policy against this. But regarding government policies, this type of uncertainty, we can't take uh, insurance policy against it. That is called uninsurable uncertainty. So uncertainty is the decision maker does not, when the decision maker does not know or can't access the probability of occurrence of certain outcomes, more information increases certainty and less information increases uncertainty. If we don't have any information, then we are more uncertain. And if we have more information regarding investment in bonds or securities on paper title documents, then that will be called certainty. And now, what is risk analysis? Risk analysis involve estimates of risk. Risk can thus be estimated. There are three types of people in whole world. One is risk lover, second is risk averter, and third is risk neutral. Some people are very interested to take risk. They are called risk lover. They want to invest their money in those financial assets which are more risky because they know that more risk, more profit, and less risk, less profit. If people are interested to invest their money in financial asset and those financial asset which involve huge risk, that is called, that person will be called risk lover. But some person whose income is fixed, they don't want to invest their money in risky assets or those assets in which return is not expected or not fixed. That person will be called risk averter. They will invest their money in banks or in fixed deposits, but not in shares, not in bonds, etc. And risk neutral person are those person who don't want to take risk, or they don't have any opinion regarding taking more risk or not. They remain always in each and every situation neutral. That is called risk neutral person. So risk analysis involve how we can estimate the risk, and risk can be estimated. Uncertainty and risk can be examined using what if and sensitivity analysis. It is a good idea when identifying variables to access certainty and risk. So these are the different terms which we can use in explaining the topic of this risk and uncertainty. We must have to remember this. What is the meaning of certainty? What is the meaning of uncertainty? And how risk and uncertainty are interconnected, or how we can estimate the risk which is involved in uncertainty time period. Risk and uncertainty. Here we can define individually the meaning of risk. Risk is referred to a situation when the probability distribution of the cash flow of an investment proposal is known. If we know that what is the probability distribution of the cash flow of an investment proposal, that is called risk. And if there is no information available to formulate a probability distribution of the cash flow, the situation is called uncertainty. So, if we can predict regarding the risk which is involved in investment proposal, that is called risk. And if we don't have any information and information is not available to formulate a probability distribution of the cash flow of the situation, that is called uncertainty. Next is we can differentiate between risk and uncertainty. In this form, risk versus uncertainty. Risk is the chance that an investment actual outcome will differ from the expected outcome. And uncertainty is the lack of certainty about an event. In risk, potential outcomes are known. We know that how much risk is involved in purchasing these risky financial assets. And uncertainty, we can't predict, we can't calculate potential outcomes. Here, potential outcomes are unknown. Risk can be measured and quantified using theoretical models, but uncertainty can't be measured. Risk can be controlled if proper measures are taken at the right time, but uncertainty is beyond our control. So, this is the basic difference between risk and uncertainty. Risk can be estimated, risk can be controlled, risk in risk potential outcome can be known by the person, and risk is the chance that an investment actual outcome will differ from expected outcome. But in case of uncertainty, potential outcomes are unknown. These uncertainty situations are beyond control. Uncertainty can't be measured, and uncertainty is the lack of certainty about an event. Now, next is probability. What is the meaning of this probability? Probability means uh, probability is the occurrence of any event. It tells us it tells us about chance of occurrence, maybe like gambling, or um, if we are taking any bet, or if we say that it may be rain today or may not be, it means it's a probability. So, probability may be described as a measure of someone's opinion about the likelihood that an event may be occur or may not be. So, it's a chance, it's a probability. A typical forecast is single figure for a period. This is referred to as best estimate or more likely forecast. So probability is the chance of occurrence. It may be occur or may not be. So probability always tells us about the chance of occurrence. Next is expected utility theory. What is the meaning of this expected utility theory? Simple utility theory was explained by or introduced by Marshall. Utility always tells us the satisfaction or non-satisfying power. What is the meaning of this utility? Utility tells us non-satisfying power. And expected utility theory is a theory which is developed by the economists by taking rational decision making under uncertainty with a minimum sets of reasonable assumptions possible. The main objective of this expected means forecast, or we can predict what we can expect that will happen in future. And utility theory always tells us the satisfaction level or maximum profit level, how we can get maximum satisfaction, and how we can estimate utility from investing our money in fixed assets or in risky assets. So its main objective is to develop a theory of rational decision. Rational decision means good decision or very particular decision making under uncertainty with a minimum set of reasonable assumptions as possible. The following are five axioms. Axioms means assumptions of cardinal utility, which is provided the minimum set of conditions for consistent and rational behavior. According to Marshall, utility analysis is based on cardinal approach. In this approach, we can estimate or we can calculate utility, and we can express how much satisfaction we can get. We can express it in terms of money. So if we can measure utility in terms of money, that is called cardinal utility. And if we can't estimate this utility by money terms, that is called ordinal approach. So what do these axioms of expected utility means? It means all individuals are assumed to make completely rational decisions or reasonable decisions. Here we are assuming that all individuals are assumed to make completely rational decision. It means all consumers or all individuals know about everything, how they can get maximum utility or how they can reduce risk and get maximum satisfaction. Next assumption is people are assumed to make rational decisions among thousands of alternatives. We are predicting here, we are assuming here that people are assumed to make these rational decisions among thousands of alternatives. Next is here expected utility theory has five axioms, and these five axioms are: number one is completeness. People can uh, compare people can compare all possible outcomes and access preferences or indifferences, like x is greater than y, if x is less than y, or x may be equals to y. It means people can compare and people have complete knowledge about two particular goods from which they can get maximum satisfaction. If people are giving more preference to x rather than y, then x will be greater than y. And if people are giving more preference to y rather than x, then x will be less than y. And if people are neutral, their preference are not regarding to particular any x or y commodity, then x will be equals to y. Next is transitivity. It means people's choices are transitive. Transitive means if x is greater than y and y is greater than z, then y will be greater than if x is if a if we assume that there are three variables like x, y, and z. X is greater than y is greater than z, then x will be definitely greater than z, because x is greater than y and y is greater than z. Then transitivity theory tells us that x will be greater than z. Next is continuity. Here continuity theorem tells us, this assumption tells us that given any certain level like W star between highest and lowest, these exist one and only one, that is called continuity. It means if we continue our consumption, then we can predict what will we get after consuming any commodity. If we continue invest our money in bonds, then we will estimate what will we get return in future. Next is rationality. Rationality is the fourth axiom of this expected utility theory. A gamble which assign a higher probability to a preferred outcome will be preferred to one which assign a lower probability to a preferred outcome. If we have two outcomes, then rational person will always take rational decision in which he will get maximum return and he will reduce maximum risk. So, at minimum risk, we want to earn maximum profit. So, if we take this type of decision, that is called rational decision. And next is fifth point is independence. A decision maker is indifferent between the two possible outcomes, then he or she will be indifferent between two gambles which offer them with equal probabilities. It means each outcome from two possible situation is a decision maker remains always indifferent between these two possible outcomes. Indifferent means we are not different. If we have two goods like x and y, either we can take more x, less y, and either we can take more y, less x. Both are giving us same satisfaction. If both goods are giving us same satisfaction, then we will be indifferent towards these different combinations of these two goods. So a decision maker, if he or she is indifferent between two possible outcome, that is called that response. Uh, or opportunities or two variables are not dependent on each other, they are totally independent. So these are the five axioms of the expected utility theory. One is completeness, next is transitivity, next is continuity, next is rationality, and last is independence. Next is, this is the graph of utility. Utility function curve, as we discussed about that people are of three types of nature. Some people are risk lover, some people are risk averter, some people remains always neutral in risk. So if people are risk averter, then utility function will be in this form. It will be a concave shaped curve, that is on y-axis we will draw right utility, and on x-axis if we have written here monthly income in thousands, then this curve is showing that there is a positive relationship between these monthly income in thousand and utility. And this curve start from the origin, then in the beginning it will be upward, and after that it will start falling. So this type of utility function we can draw in case of risk averter. If people are risk averter, then utility function curve will be like in this form. Next is, if people are risk averter, then curve will be concave, and if people are risk neutral, then curve will be a straight line, and if people are risk seeker or risk lover, then curve will be convex to the origin. So these are the three different situations of the people. People may be risk lover, people may be risk averter, people may be risk neutral. So in case of these three situations, we can express it with the help of different forms of this diagram. And in case of risk averter, the diagram shape will be like this, concave. And in case of risk lover, diagram will be convex shaped curve. And in case of neutral, diagram will be straight line curve. On y-axis, we have written here utility, and on x-axis we can take value. Next is a von Neumann Morgenstern explained this expected utility theory, and von Neumann Morgenstern also explained game theory, and they explained expected utility theory in form of risk premium and cost of gamble. In this, if cost of gamble is higher and the return is lower, then people will, if people are interested to take less risk and not interested to take more risk, it means they will be called risk averter. So in case of risk averter, curve shape will be concave to the origin. So this is the risk premium and cost of gamble. Here, current wealth and certainty equivalent is equals to X wealth is cost of gamble is 82.76, and the risk premium is 8.24, and expected wealth in gamble is, we can estimate it with the help of this formula, that 101. Here winning gambling, in this case if there is a 10% chance of winning, it means 90% chance of losing. So we can estimate in this form, and we can express it with the help of this concave shape curve. In case of risk averter, then utility function is a choice problem designed by Morris Elias 1953 to show an inconsistency of actual observed choices with the predictions of expected utility theory. Alias is the name of the person, and is the paradox is the theory which tells us that if one thing is increasing, that other thing will not increase. If there is a paradox, like if we say that there are two types of branches of economics, like microeconomics and macroeconomics, if one thing is good in case of microeconomics, then it will not be sure that it will be good in case of macroeconomics. Like if we cut one tree, then deforestation will not occur, pollution will not increase. But if at micro level, uh, cutting one tree is not bad for the economy, but at macro level, we studies always whole units of the economy. If we cut all the forest or deforestation, then definitely it will increase the pollution level. So at macro level, cutting trees are not good, but at micro level, cutting trees is not bad. So this is called paradox. And Elias paradox is a choice problem designed by Maurice Elias to show an inconsistency. If two things are consistent, that will be give us less variation. If less variation in two variable exists, it means more consistency. And if there is a more variation in two variables, then it will be called less consistency. And less consistency means inconsistency. So it shows an inconsistency of actual observed choices with the predictions, what we predict about the future or expected utility theory. So Elias paradox arises when comparing participants' choices in two different experiments, each of which consists of a choice between two gambles like A and B. Either he can choose A. If A is chosen by a person, then B will not be good for him. And if he choose B, then A will not be good for him. So this is the paradox between these two gambles, each of which consists of a choice between these two gambles. And we can compare choices with the help of this Elias paradox. Next is Ellsberg paradox. This also another paradox which explained by Ellsberg and the common consequences principle. Common consequences principle: if two options have the same consequences given some outcome, you should ignore this common consequences. You should base your choice on the aspects of the options that differ. Here, this payoff matrix, we have taken two choices. One is choice 1 and other is choice 2. In choice 1, option A and option B are given. Here 30 balls are red and 60 are yellow and some balls are blue. So option A tells us that 30 balls red in case of $1,000, X blue is $0, and 60 minus X it is if we deduct 60. Total number of balls are 60. If 60 minus X, then another ball will be called yellow. So 60 minus x will be yellow. So if we are getting this option $0, $0, and next choice 2 in case of $1,000, $0, then 0,000. If there are same options in this common consequence principle is like $0, $0, round circle of orange and round circle of this purple. These two circles are showing that here common consequences principle are applying. If two options have the same consequences given same outcome, some outcome or same outcome, you should ignore this common consequences. You should base your choice on the aspect of the options that differ, like thousand, zero, zero, thousand. So we can take this option while making decisions, and we can ignore the same options like zero, zero, thousand, thousand. We can ignore these two options. This is called Ellsberg paradox or common consequences principle. These all things are applied in psychology, and while we want to take rational decision, then we must have to know about these things. Next is intertemporal choice. Intertemporal choice is a choice in between of present time period and future time period. It tells us about the choice in between of these two time period, like present and future. If we are giving more preference to present time period, then future time period we will give less preferences. And if we are giving more preferences to future, then we will save our money in banks or in securities, and we will spend less money in present. So person often receive income in lumps or in, for example, monthly salary. How is the lump of income spread over the following month? Saving now for consumption later, or consumption now and saving later. There is a choice in between of saving and consumption. If we consume more at present, then we can save less for future. And if we consume less at present, then we can save more for future. So there is an intertemporal choice. If we are giving more preference to present time period, then we will giving less preference to future time period. And if we are giving more preference to future time period, then our preferences towards present time period will be less. So we have to make a choice in between of these two time period. These choices may be regarding consumption or saving. These choices may be regarding investing our money in bonds or spending our money in consumption. So how is consumption financed? By borrowing now against income to be received at the end of the month. So all these decisions are taken by using this intertemporal choice. So intertemporal choice tells us about uh, the decision regarding present or future time period. What we choose, if a rational person take rationally decision, then he will save some money for future and consume also. He will divide his money in two parts. One is consumption and other is saving. Next is discounted utility model. Now discounted utility model is a model in which discount factor compresses many forces like mortality, uncertainty, and time compression. Accepted as normative and descriptive, but initially arbitrary, according to Samuelson, 1937. Utility and consumption are independent and exponential, and time consistency. All these things we can use while expressing this discounted utility model. So discounted utility model tells us about discount factor, or discount means concession or rebate factor, which compresses so many things like mortality is the death rate of the country people. Mortality is the rate at which we can estimate how many people are um, how many people are dying. And uncertainty, we know that if we can't expect about future, and we can't expect regarding any outcome of the event, that is called uncertainty. And as well as time passes, then uncertainty may be rise and accepted as normative and descriptive but initially arbitrary. This factor may be normative and we can explain it in descriptive way. Utility and consumption, we assume that both are independent and exponential. Here is time, consistency we can take here by using this model. Next is assumptions of the rational decision making model. When we want to take rational decision, some assumptions we have to made while taking decision, rational decision. One is problem clarity. If we want to take rational decision, first of all, we should clear the problem. The problem is clear and unambiguous. There is no confusion. If there is no confusion, the problem is clear, then we can easily solve that problem. So if problem is clear, then decision can be taken by us rationally. Second thing is known options. If decision maker can identify all relevant criteria and viable alternatives, then he can make rational decisions. Clear preferences in rationality assumes that the criteria and alternatives can be ranked and weighted. If our preferences are constant, then specific decisions criteria are constant and the weight assigned to them are stable, then we can make rational decision. If no time or constraints are present, then if there is a full information is available because there are no time, no cost constraints, then rational decision can be possible. And maximum payoff highest perceived value. So if choices are available and we make rational choice in between of given options, then our rational decision can be exist. So these are the assumptions of the rational decision making model. One is problem clarity. Problem should be clear. Then we can take rational decision. We must have to know about all the options, clear preferences, constant preferences, no time or cost constraint, and maximum payoff. These are the assumptions of the rational decision making model. Next is prospective theory. This prospective theory is normative theory. Normative decision analysis theory assumes that outcomes of decision are described in terms of total wealth, prosperity, or prospect. Prospect theory tells us about total wealth. In reality, prospects are considered in terms of gains, losses, or neutral outcomes relative to some referred or reference point. In prospective theory, a decision maker considers prospects using a function that values our prospects relative to our reference point. This prospect theory diagram is like this form. Here on right hand side we have written gain and on left hand side losses are mentioned. So the pain of losing is psychologically twice as powerful as the pleasure of gaining. Now we can conclude from this today's unit 8. It is important to incorporate the risk into the evaluation of investment and when deciding about accepting or rejecting projects. Risk is the likelihood that the return of an investment can be affected in an unfavorable way. And certainty